gonna have to change my keys, but it's fine. All right, so CPI data, right? How to treat CPI data and a complete guide for traders. So inflation is one of the most powerful forces or driving global markets. Understanding how the consumer price index data can provide you with a significant edge. Now, you're wondering how the word CPI is equal to inflation. Well, this is what it is. Let's start with the word inflation itself. Inflation is the rise in the price of goods and services over time, representing a loss of purchasing power in fiat currency. So the currencies you use, dollar, pound, euro, naira, kobo, coins, whatever currency it is you use, apart from Bitcoin is crypto. Those are fiat currencies. Now, how does consumer price index actually show inflation? You can see it's right in the name. The name is CPI. Sorry, let me use a pen. So the name is CPI, right? And it stands for the word Consumer Price Index. So it's an index of consumers' items price. That's the price of consumer items. That's what it is. So it's an index of the price of consumer items. Now, if I'm calculating the price of consumer items and I notice that the price is always ticking up, it just means one thing, right? The price of things are going up, and the price of things are going up is exactly what inflation is. So the price of goods and services over time. That's just everything you need to understand about how CPI is the measurement of inflation. Sorry, just want to check some things, make sure we're all good. Okay, we're up to date. Now, the role of central banks. Central banks, such as the Federal Reserve in the US, aims for a 2% inflation target to ensure sustainable economic growth. When inflation deviates from this target, central banks intervene by adjusting interest rates to stabilize the economy. So, what that means is this: the central bank, the central bank looks at inflation rate as one of the most important, in fact, it is the most important tool in their arsenal. This is the thing that they are looking out for. Why? It's simple. So why do they actually look at for price? Why in particular? Well, high inflation, it leads to economic instability, it erodes purchasing power and increases the cost of living. I'm pretty sure you already know this, right? Then we have low inflation, which can signal weak demand for a potential recession. And then the sweet spot is when the inflation is actually moderate. So stable inflation is ideal as it balances growth and employment. Now, understanding CPI and the core component. Before I move into understanding CPI and the core component, I just want to make sure you understand what we're really looking at here. Now, inflation itself, when normal citizens hear the word inflation, they don't feel so happy. They don't feel it's not really there's no happy ending to the word inflation. So when they hear inflation, that was a mistake. That's an error. I need to go back a little bit. So when people hear the word inflation, they feel like it's a bad thing. Yes and no, it is a bad thing. It's a bad thing if it is too much. So if the inflation is too much, it's a bad thing. But if it is too small, it's also a bad thing. So you know this saying where they say too much of anything is bad. So too much of inflation is bad, too much of no inflation is also bad. There is a moderate stance for it. There's a level where it's fine, it's okay. For example, let's say price of an item is is, let's say, $10, right? It costs you $10 to buy an item, and due to inflation, at the end of the month, end of the year, it costs you, let's say, $10 and 20 cents for you to purchase that item. It's still fair, very fair, right? And then the next year it will cost you, like, let's say the same. It will cost you about $10 and about 22 cents to buy it another year. So it's a fair price. It is good, and it is not as demonic as people think. So what makes it bad? Well, what makes it bad is that if you, let's say, you buy an item for $10 and it deflates, meaning it loses value, it will drop to something like $8. Now, you that own the item, it's a bad situation for you. Why? Because you will not make money out of this fall. But if you had bought it at $8 and it went up to $10, you would make money out of it. So this one is where you lose money. This is where you make money. And if you look at it carefully, just look at it carefully right now, the way with what I just explained, what you'll notice is that we actually want prices of things to go up, so that whosoever buys it today will be able to sell it higher tomorrow. And mind you, this thing favors business people more than it favors normal you and the individuals. That is, you and I, the standard everyday people who are buying and consuming items. So it does favor businesses a lot more. This method of calculation does favor, but it also favors the individuals to an extent, right? If the economy was good and everything was done right, it favors the individuals also, because no business will want to create an item for a total cost of $100. So everything they did, the staff, employment, the tools, and everything cost them $100. They have to sell it for at least a bit higher than $100, even if it's at $110. Even if it's $110, it's something. At least they are gaining that $10 to sustain themselves. Now, if inflation is outpacing this $10, that is a problem. You understand? That is where the whole situation becomes terrible. The moment inflation is eroding this $10. So let's take a good look at the scenario now. It's inflation at 10% is already making this $10 that they made useless, because already, because of inflation, after they produce the item and sell it, the item automatically becomes $110. The cost of production of the next one will cost them $110, and they just sold it for $110. Hence, they did not make any money. So what they are trying to do is, what is trying to happen is, inflation affects not just cost of production. So there's a cost of production. Inflation also affects every other cost incurred, as well as it detects the income, the same way it detects the income of a lender. So somebody who lends money, let's say he lends out $1,000 to somebody, you expect the person to pay you $1,000 and more. That's standard, right? So if inflation is so high that, let's say you charge 1%, right? You charge 1% of this money. 1% will be $10. So the person is supposed to pay you $1,010 at the end of the period of borrowing the money. But pardon me, sorry, I just want to confirm some things. Excuse me, sorry, I just want to confirm. So if the market is $10, right, and you charge, if the inflation rate, sorry, if the inflation rate, I'm making a mistake. If the inflation rate is $10, sorry, 10%. Did I say $10? Oh, I'm sorry. I'm just making a lot of mistakes right now. So if the inflation rate is greater than 10%, and you are charging 1%, you can see that you are at loss, because By the time this person returns this money back to you, whatever you would have used this money for is now worth is now what, let's say, 1,100 bucks. So you're basically at loss. That's just the fact. You are at loss because you did not take a proper view of the economy before you started giving out money for cheap. Pardon me, just want to confirm some small things, making sure that everything we have is working fine. Okay, we are working fine. It is live. Alright, so apologies for that. I had to make sure I confirm. Jeez, I think this thing is too loud. It was kind of bleeding just now. Alright, is still too loud. Alright, wow, that is still loud. Alright, let's move on to the next part of the whole thing. So now you understand the logic behind inflation rate and why inflation rate exists in the first place. It's there to keep the economy running. Now understand CPI and core components. The CPI measures the cost of a basket of goods and services, including housing, food, energy, transportation, and medical care. To get a clearer view of underlying trends, traders often look at the core CPI, which excludes volatile items like food and energy. Central bank prioritizes core CPI when making long-term policies. So, the three stages of inflation. Understanding the three current inflation environment is critical to the strategy. Now we have the first one called deflation, disinflation, meaning CPI level is less than 1.5%. Now, when the CPI level is less than 1.5%, if the central bank's target is 2%, right? The expected Fed action is that they may cut rates. Now, mind you, um, this rate of the things, the interest rate you have been hearing of, which we talked about in the last video, the interest rate is determined not just because of, in this case, we talked about GDP yesterday. We also talk now we're talking about inflation. So it's not just inflation. The central bank looks at a lot of data before they decide a interest rate. So one, they've looked at GDP. Today we're looking at inflation. That's another thing they look out for. So there's a sweet spot between 1.6 to 3.5%. So at this amount, central bank may hold rates. And then hot inflation greater than 3.5%. At this point, they may hike their interest rates because at that point it's becoming too unbearable. If I should use that word, it's becoming unbearable for people. So understanding how inflation affects markets can help you trade effectively. Sorry, I just want to. It can help you trade effectively. The impact of inflation on various assets depends on whether the economy is experiencing disinflation, moderate inflation, or hot inflation. So trading disinflation, a situation where the CPI is constantly coming out at less than 1.5%. When inflation is low, the Feds may cut interest rates to stimulate the economy. So in that situation, gold, silver, and currency gains value because inflation is low. Things like stock indices and even the US dollar itself, basically, because the US dollar is kind of like it's a mixture of a currency and a stock of its own because it's the international world's payment system. So when you people buy it to keep it as stock, then we have the trading the sweet spots, which is stable interest rates. The best thing to buy during stable interest rate is stock, indices, and non-USD currencies. So any currency that doesn't have the US dollar in it. And then we have the bearish situation of that place. Things that are going we expect to go bearish is things like gold, things like the US dollar. And let me explain this thing a little bit in depth, but I will come back to it. I'll explain it a little bit in depth. Just give me a second. Then we have trading hot inflation, which is CPI is greater than 3.5%. Now, when inflation rises rapidly, the Feds may hike interest rates to cool the economy, which is bullish for gold, right? And silver as inflation hedges, and it's bearish for the US dollar due to the power purchasing erosion. It's also bearish for stock and bearish for indices due to higher interest rates and interest input costs. Now let's look at the whole situation properly and understand it well. How does interest CPI, the consumer price index, less than 1.5% really affects the individual? How does it make the individual? How does it really affect things like gold, silver, and currencies? If they have strong fundamentals, don't forget it's not just gold, silver, and currencies at random, but they have to also have like good fundamentals at that point in time. I'll explain what I mean by fundamentals soon. But let's look at it. Gold, silver, and currencies must have some with strong fundamentals are good to buy when the inflation CPI is lower. What does this mean? So let's paint a simple scenario, a scenario that very understandable. The cost of buying an item, right, is beginning to is beginning to it's not growing fast. Let's just say it's not growing fast. So let's say the cost of buying an item of 10 bucks, it's only gonna move all the way to 10 bucks and 10 cents at the end of the year, and the next year it's gonna move up to 10 bucks and 11 cents and 20 cents, just like that. So it's moving up slowly every year. It is moving up. If you had money in your hand, would you want to put your money in business, in a business that's going to be giving you 10 bucks at the end of the year? Or would you look for something that you know for a fact that, okay, if I put my money in here, I'm going to get much more money? In this case, take a good look at this item. This is called a precious metal, gold, silver, and currencies with strong fundamentals. So if your own country where you are staying has a low interest rate and hence has a low CPI and hence your cost of item is not developing fast enough, you can take your money and go to another country that has a better CPI data and use your money to trade their goods and services, and you make more money. So that's the first one, right? That's the first one. And for the other one, I've ruined it. Sorry. Just want to adjust the size of the pen back. Now, for the sweet spot, when inflation is moving as it ought to be, you want to buy things like the stock market, things like indices, and things like non-USD markets. How and why? Why would you want to buy things like this? So, at this point in time, the prices of things, before I even come down here, just look at what's happening here. So, if prices of things are not going up too much, right? It's not going up too much. People are going to look, oh, I have enough money. I have enough money. I can also buy more gold. I can also buy silver. Do you understand? Right? In this other place, prices of things are going up in a way that it equals what you are making. So they are like, there's no need to buy gold. We don't need to buy gold yet. We can't buy the dollar and hold currently. So they're not going to be buying anything that has to do with like actual buy and hold for too long. The only thing that they can buy and hold are things like stock, things like indices, because they know that companies that are producing items that own stocks, companies like Apple and Google and the rest of them, they have items that people use every day, and things like their subscriptions is going to cost money, and obviously they would raise their subscription over time. They would raise the price of their subscription over time. Hence, you want to be investing in things like this by buying their stocks and holding their stocks so that as they increase their cost of subscription, they will also increase the dividend they pay back to you. Buying gold at this point is not going to make much sense. Why? Because the economy itself is moving in a way that if you put your money in the right place, it is going to also grow. Hence, buying gold is not going to make much sense. Same thing as buying dollar and trying to keep the dollar in your pocket. It's not going to make much sense. Then we have hot CPI. Hot CPI, what does this actually entail? Well, hot CPI is quite simple. Hot CPI is when the prices of things are skyrocketing, right? Everything is going up. The feds may hike their rates. Now, in situations like this, what happens is, funny enough, this is actually the funny time to buy gold and also buy silver. Why? Because we know that as things are going more expensive, people are going to need their money from wherever it is. If people are removing their money from wherever it is, companies like Apple, Google will have less funds available. They're having less funds, but at the same time, the price of their items or subs is going up. People, less and less people are subscribing. It's going up even higher. Less people are subscribing, and it's going up even higher. So it's just a cycle of debt, right? It's a cycle of debt of its own. But at the same time, because we know that the interest rate is going to go up as a trader, and central bank is most likely, not now, we're not saying that it will just go up, but central bank is most likely to make the rate go up. The target is to go and buy gold and keep your money in gold, because gold appreciates steadily. So you keep your money in gold, keep your money in silver, and say when the economy stabilizes, you sell gold for a higher price than you bought it. That's just the whole idea behind this whole setup here. There's no much of a thought to it. So let's just look at an example. So example, this is 2026. US 2 years yield now falls as September odds hits 33%, 38%. So all of these are all things related to CPI. I don't need to read them much. So monitor CPI reports, stay updated on the data releases and central bank commentary. So central bank usually comments based on this stuff. So always listen to its commentary. Adjust asset allocation, tailor your portfolio to match country current inflationary conditions, and then prioritize risk management. Use tight risk controls as inflation data often triggers high market volatility. So this is all for CPI inflation. And let's move on to PPI. So how does PPI and CPI actually relate? Now, PPI is Producer's Price Index, and just like CPI, Price Index. The first one is the consumer. This is the producer. So the Consumer Price Index is how CPI is how the prices of things, goods and services being consumed. So it's the prices of how goods and services being consumed by people. This is the price index of goods and services being consumed. While producer price index is the cost of materials for production. So this, on the other hand, is the cost of materials for production of those goods, and sometimes the cost of producing those services, you see. So this one is for us consumers, and this one is for majorly companies, because they are majorly producers, and then people who own businesses. Now, how do you know the situation of these guys? It's a key economic indicator that measures the changes in the price of producers. Sorry. PPI is a key economic indicator that measures changes in the prices producers receive for goods and services. Since rising producer costs can lead to higher consumer inflation, PPI data often influences market movements, interest rates, and central bank decisions. So let's just scroll down and go straight into the meat of the stuff, right? So what is Producers Price Index, PPI? Producer Price Index is an essential economic indicator that measures the average change in the selling price received by domestic producers for the goods and services over time. Unlike CPI, it tracks prices change from consumers' perspective, which tracks prices change based on consumers' perspective. PPI focuses on the producer's side of the economy. The index is compiled by the Bureau of Labor Statistics and is widely used by traders, investors, and economists to assess inflationary trend. So PPI includes multiple sub-indices that categorize goods and services by industry, commodity, and stage of processing. These sub-indices help provide a comprehensive view of price changes at different levels of the supply chain. A rising PPI suggests increasing cost for producers, which may eventually be passed down to consumer, leading to a broader inflationary pressure. Now, PPI is more like this is how you should look at it. PPI is the reason why CPI will grow or fall. So so this is the reason why CPI will grow or fall. If PPI determines what happens to CPI, and CPI is part of the things that determine what happens to the CB rate, so the central bank rates, it means that if you're a smart person, right, you will take your eyes straight to something like PPIs first. When PPI starts to produce higher data, you know that CPI will soon start giving you higher data. And the CPI will soon start giving you higher data, you know that central bank will soon be under pressure to hike interest rates. So it's just that simple. There's not much to this whole thing. It is that simple. So why does PPI matter to traders? So PPI plays a crucial role in financial market because it serves as a leading indicator of inflation. Inflation impacts in interest rates, it impacts monetary policy decision, corporate profits, and overall market sentiment. Here's why traders track PPI closely. Inflation expectation. I already told you how it affects every other thing. So a higher than expected PPI reading may indicate that inflation is heating up, prompting central banks to start considering tightening monetary policies by raising their interest rates. Conversely, a lower than expected PPI reads suggests workers' inflation pressure, weaker inflationary pressure, which could lead to accommodative monetary prices. So this is what you should observe. For PPI, if this is PPI right here, so if PPI is higher than expected, or rather higher than, is growing up, basically. If PPI is going up, everybody expects CPI to go up. And because everybody expects CPI to go up, Feds are going to have to come in and say, okay, let's raise the rates, interest rates. Why are they raising interest rates? Well, multiple reasons, apart from this situation, but multiple reasons. But what is this raising the rates going to actually do? Well, it's simple. When the interest rate goes up, the price of getting things, right? The price of getting things for the company will become a bit harder. Company will become a bit careful. They will reduce the amount of workers they have, to reduce the amount of productions they are producing, to reduce a lot of things. Now, when they start to reduce all those things, the cost of their item would either remain stagnant or it will even drop. Do you understand? The same way the cost of producing the item, that's let's say raw material and anything, it's the same way the price will remain stagnant or drop. Now, if this starts to slow down, we'll know that CPI will start to slow down. When CPI starts to slow down, central bank can then slow its rates down also. So rate implications, right? Interest rate implications. Rising PPI data often leads to expectations of higher interest rates, which strengthens an economic's currency as investors seek higher yield. Financial investors. Lower PPI reading can result in lower expectations of interest rates, potentially weakening the economy. the currency, sorry. Corporate profit margin. A rising PPI may indicate that businesses are experiencing higher productions. If they cannot pass this cost onto the customer, their profit margins will shrink and it will affect their stock price. A declining PPI may signal lower input costs for businesses, potentially boosting profit margin and stock valuation. Market volatility. PPI data releases can cause significant short-term price fluctuations in stock markets, in the bonds markets, in the forex market, and also in commodity as traders react to inflation expectations. All traders do that. So when is the PPI reported actually? Now, the US Bureau of Labor Statistics releases PPI on a monthly basis, typically around the middle of the month. The report usually includes data for the previous months. Now, providing the insights into recent inflationary trend. So, PPI is more of an inflationary trend. What would happen soon? The more PPI prints a particular trend, the more that thing is going to happen. So, in addition to the headline PPI figure, the report also breaks down price changes in different industrial sectors. Now, core PPI, this excludes food and energy prices, just like core CPI excludes food and energy, providing you a clear picture of the underlying inflation trend. But this one will also have something called final demand PPI, which measures price changes for goods and services sold to final consumers. So, for example, your iPhone, right? When they sell an iPhone directly to you, it has a different price from the amount they sell to a supplier. So suppliers get a different amount, and then the actual consumer gets a different amount. Now, supplier is able to know how many consumers they will get. So it's let me show you what it means. So intermediate demand PPI tracks price change of goods for goods and services used in the production of final goods. So there is also the manufacturer situation. So who are the manufacturers? Let's take cocoa for example. The farmers, the um, the farmers, the processing centers. These are the manufacturers. Now these ones will trickle down their price to suppliers. After they finish making the item, they will sell to suppliers. Suppliers will then sell to consumers. So the pricing is a bit different on these three levels. Now how PPI impacts markets. PPI can have a significant impact on the markets, right? If it has a hot read, I'm skipping all of this talk. So a hot read in CPI in PPI, sorry, data signifies a higher than expected increase in inflationary pressure. Obviously, if you expect inflation to really go up, we've already seen from CPI that things like gold, things like stock, they become very favorable to buy. Sorry, things like stock, things like USD become favorable to buy. But when inflation is so high, right, rising inflation and the expectation of higher interest rates may threaten the US dollar, but it makes gold less attractive to keep your money. I mean, inflation is going to need you to have enough money in your pocket, so you will not want to buy gold. Gold is somewhere where you buy it and keep. Now, a cool read, meaning if PPI is beginning to come out and it's cool, you do not want to actually be buying stock because, I mean, PPI is that the producer is doing things at a lower rate, at lower money, slower economy, slower demand. They will not be selling as much. So you will not want to buy the stock of a company that's not selling as much. Instead, you'll take that cash and you put it in things like gold, silver, copper, which are items that even some of these producers need to produce their stuff. And also with the fact that we know these items are rare metals, so therefore they will keep always um, going up in value. Now, PPI trading strategy. Traders can use PPI data to formulate effective trading strategy, aligning positions with expected market movement below are the strategies based on different PPI scenario. So what PPI strategy? Forex traders, if PPI exceeds expectation, they consider to go buy the dollar against weaker currencies, as rising inflation may push central banks towards tightening monetary policy. Stock traders, they look for bullish opportunities in inflation-resistant sectors, usually the commodity, financial, and industrial, which may benefit from rising rates, right? The rising price. And then gold and commodity traders, because of this situation, they look to sell the market. They need to sell gold markets for small money. Now, a cool PPI for forex traders is actually now doing the opposite. The first time they were buying the dollar, so now they would actually be selling the dollar and taking advantage of other currency. For stock traders, they'll be doing the opposite of looking for bullish opportunities. They will not want to buy anymore. They'll have to defend the small money they have by either scrutinizing their current stock or even taking out of some stock because the economy is about to slow down or is even showing signs of slowing down already. And last but not least is gold traders. Now, lower inflation rates and potential for lower monetary policies may weaken the USD. If the value of dollar is not going to keep going up, that's where gold actually wins. You want to put your money in metals and use the metal money to make more money. So PPI is the most effective way is most effective when used in conjunction with other economic data points and economic indicator. By analyzing the PPI alongside other factors, investors and analysts can gain a more comprehensive understanding of economic trends and potential market movement. So it's something you just need to leverage on and understand what is going on. So again, just for the recap, PPI, the producer price index, measures the wholesale price changes, often signaling future consumers' inflation trend. Then we have a hot PPI reading. When a hot PPI reading comes in, you know that the economy is growing. The economy is growing quite fast anyway. And things like the US dollar, of in this case, things like a country whose currency's PPI is fine, those are where you want to be buying. And then you do not want to actually buy gold, metals. Then we have PPI is released monthly. Then we have the situation where PPI is cold, where you want to buy metals because of the fact that you know that the growth rates of your money in other places is going to be slower. Now, PPI is released every month. It's typically around the middle of the month, and it's making it as a key event for traders watching inflation. For the best insights, combine PPI analysis with things like your CPI and GDP and employment data also to see the current market trend that's actually ongoing. Reacting to PPI alone is not good enough. Successful traders, they use predefined entries and stop loss, and then they have good risk management. So because PPI data came out positive does not mean you should go hit buy on US dollar just blindly. You need to look at the market itself also. The technical data itself matters, how the market is looking.